Welcome back to the Dukascopy TV studio. I'm Natalie MacDonald. Joining us now is Mourtaza Asad-Syed of Société Générale. Mourtaza, thank you very much for coming in.
Thanks for having me.
Now we're going to take a look at the US, and after a long summer of uncertainty really over US tapering, investors still remain confused really about the Fed's policy moving forward. With a big question mark over volatility as we head into Q4, is it fair to say really the Fed need to find a smoother way to indicate policy change?
From recent market moves into like rising yield up to 3% on the 10-year, US Treasuries to 265 right after the FOMC. Clearly, the Fed brought a lot of noise on the bond market, or maybe mismanages communications. Hard to say, but clearly we cannot say that it was a very smooth transition to higher yield. So maybe something could have been better if you really look only at the smoothness of the interest rates. About uncertainty, is this really the conclusion we should take into, is the Fed increasing uncertainty on the market? We're not so sure. It's increasing the uncertainty about what the Fed is doing. That's a bit for sure, because a lot of people were thinking the Fed said they were going to taper. So this, of course, is bringing uncertainty. But we feel that what matters is really the outlook of the US economy. And in fact, the tapering or the increase of yield was bringing uncertainty on the outlook, which was maybe to slow down the mortgage process, the housing process, into refinancing and just the mortgage lending with higher rates. So in fact, by being a little bit more uncertain on the interest rates, it seems that it also lowered the risk of a US economy slowing down with an issue in the housing recovery. So I would say it's uncertainty on the monetary side, but it's lower risk or less uncertainty on the economic side. So maybe it's the price to pay of the Fed saying, I'm going to be data dependent, I'm going to be endogenous to what's happening in the economy, but in other sense, it says, I'm not going to hurt the economy. I'm going to try to have the economy cruise as much smoothly as it can. So depends. I think it's most like shifting the uncertainty and maybe bringing volatility on the bond market. But the bond market also now understands that it cannot overshoot. It will have less tendency to overshoot. Our view is that normalization process is still here, which means that the discussion, the message from Bernanke is going to be carried by the next chairman into next move is in the tightening mode. It's QE is dying. It's just a matter of time when, and we expect the rate hikes into 2015. So it's more a matter of delay, but the trend is there into higher yield and normalization of monetary policy in the US.
So we've got tapering on one hand, and we're in the midst of a battle regarding the US debt ceiling, which is fast approaching. What would you say to comments that the US is broke essentially and can't actually afford to heighten the debt ceiling?
I would not say the US is broke, because otherwise you have a incredible number of countries that are already broke when the US at about 105% of GDP of debt would be considered broke. And especially when you consider that a lot of this debt is held by the Fed, which is owned by the government. So if they want to erase this debt and lower to 60% of GDP, it can be just done by a piece of paper. But I would say this is a stretch. What we view about the debt ceiling is the new episode of the American soap opera of buzzword coming from the last 4 years: debt ceiling, fiscal cliff, tapering, and now again debt ceiling too. We're a bit fed up, we're a little bit tired, but each time there is a risk that we cannot dismiss, but we feel that might be not as disruptive as a slowdown in the economy. What really matters at the end of the day is the US outlook, the US consumer, the housing, the job market. Debt ceiling discussion in the Congress, dispute in the House, we have seen it's recurrent. It's an issue that came with the election of Obama. Obama never managed to have a strong leadership into like all houses, and the Republican always managed to, play the game tough. So we know it's going to be tough. We think the risks are quite limited it's mostly wait and see, and the market is sort of in the limbo, but it's not a bearish news, it's just, you know, an annoying news about the fact that, yeah, again, we have another deadline and we have to wait, but often it turns into an event. We have to remember that the US defaulted already in its debt in '79 for a similar reason, about like technical factors that really prevented the Treasury to pay their coupon and on Treasury bills. It has happened already. It was not a disaster, so we're not pessimistic about this story, and we would like again to put it on the side, saying, you know, it's again a buzzword. After we just killed the tapering story, just now we have another one. Just move on. What really is key is 2014. Will the growth be there, and how the equity market and the dollar will behave?
In your view, then, how is Q4 likely to play out from an investment perspective?
Yeah, this is the key issue, because we have a lot of buzzword and a lot of, I would say, noise. What really is interesting for us is what will drive the equity market, especially and the risk assets. We are quite positive on this quarter, year end. On the S&P, we expect smooth growth. 1750 would be our target, which is a 3% increase. Often clients or investors would say 3% is not really worth the risk, but 3% on a quarter basis means 12% on annual rate, and this is above average return. So that's why
when it starts to get interesting.
It starts to be interesting, and when we have expectation of above average expected return, we translate it in being overweight. We buy the market, and this is exactly what we say. We are buying the US market. We're not expecting 10% in a quarter, and we'd be very suspicious when we saw the overshoot right after the FOMC. We're a bit suspicious. We say, wow, that's not what we like in a market where we expected like 10 to 15 annualized expected return to have 2% in one day. So we are comfortable with the market, and we would take profit if there were no overshooting. But right now, I think the market is taking a pause, waiting. There is bad seasonality between September and October. There is this issue of the debt ceiling, which is annoying, which is an annoyance that I think is hopefully going to be removed, and maybe the market momentum is going to restart really full force, exactly as last year, pretty much November, December.
Mourtaza, thank you so much for coming in. Always a pleasure to receive your views.
Thank you.
That's all we've got time for right now, but we'll be back shortly with more exclusive interviews for you, so don't go away. Goodbye for now.